In the vast landscape of financial products available in the market, investors often find themselves grappling with the challenge of understanding and identifying suitable investment options. The excessive of financial information emanating from both authorized and unauthorized sources further complicates the decision-making process for investors. The task of investing hard-earned money can be overwhelming, especially for disciplined investors, making it imperative to navigate the investment terrain with caution to avoid any potential mistakes that could jeopardize one's financial stability. Regrettably, many investors tend to neglect the invaluable lessons that can be learned from the mistakes of others. By acquainting oneself with the common investing pitfalls that most investors and traders tend to fall into, it becomes possible to steer clear of these same errors. This video seeks to shed light on the 16 most prevalent investing mistakes and offer guidance on how to avoid them. Number 1. Replicating others' portfolio. The temptation to imitate the impressive returns generated by friends, colleagues, or family members' portfolios is a common phenomenon. However, this approach often overlooks the effort required to truly understand the underlying products. It is crucial to acknowledge that a one-size-fits-all approach does not work in investing. While returns are an important factor, they should not be the sole criteria. Investors should engage in careful research and evaluation of a product rather than blindly replicating somebody else's portfolio. Factors such as underlying assets, risk level, and the issuer's track record should be taken into account. Number 2. Trying to time the market. The practice of timing the market is prevalent among equity investors, who base their decisions on predictions about future price movements. Attempting to sell investments when anticipating a market downturn is fraught with uncertainty. It is essential to recognize the inherent difficulty in accurately timing the market. Moreover, such attempts may hinder the realization of long-term financial goals, as frequent selling can lead to missed opportunities, such as the benefits of compounding. Number 3. Not diversifying the portfolio. The age-old adage, "Don't put all your eggs in one basket," holds true in the world of investing. Investing all funds in a single asset class exposes investors to significant risk. Conversely, diversifying across different asset classes serves as a risk mitigation strategy. For instance, if all savings are invested in equities, a market crash could result in substantial losses. However, a diversified investment across various asset classes could minimize the impact of such a loss. Number 4. Not considering inflation. A common oversight among investors is neglecting the impact of inflation on their returns. Over time, the value of money erodes due to inflation. As the cost of living increases, it becomes essential for investments to aim for returns that exceed the rate of inflation. This proactive approach helps to preserve and enhance the purchasing power of the invested capital. Number 5. Chasing fads and trends. Investing based on short-lived fads and trends can be alluring, promising quick financial gains. However, these trends often disappear as rapidly as they emerge. Engaging in such investments without a thorough understanding of their true value can lead to financial losses. It is advisable to focus on long-term investments with a solid understanding, reducing the harm to temporary market excitement and fostering a stable financial future. Number 6. Holding on to idle investment. Investments should be viewed as tools to reach financial targets, not as targets themselves. If investments are not fulfilling their intended purpose, investors should be open to taking action. Emotional attachment or stubbornly holding onto investments can be detrimental. Periodically evaluating investment performance and making necessary adjustments or corrections is essential. Flexibility is key to ensuring investments align with financial goals. Number 7. Investing without gaining proper knowledge. Investing without sufficient knowledge of financial markets is a common mistake. Diving into investments without understanding the underlying principles and risks can lead to uninformed decisions, potential financial losses, and susceptibility to scams. It is crucial to educate oneself about investment strategies, risks, asset allocations, and specific investment options to make informed choices aligned with financial goals. This education can begin with reading and watching online financial news, blogs, articles, books, and other reputable sources. Number 8. Emotion-driven choices. Investors may be influenced by emotions, particularly fear and greed, when making investment decisions. Fear can lead to selling assets during market downturns, resulting in significant losses. On the other hand, greed can drive investors to take on excessive risk in pursuit of substantial gains. Emotions can cloud judgment, leading to irrational decision-making. Therefore, it is essential for investors to remain level-headed and rational when making investment decisions. Number 9. Focusing too much on taxes. While considering potential tax consequences is important, making investment decisions solely based on taxes is a common mistake. The decision to buy or sell a security should be primarily driven by its merits, with tax considerations as a secondary factor. Being smart about taxes, such as tax loss harvesting, can enhance returns. but the primary focus should be on the investment's fundamentals. Before we move on to number 10, please, if this video bring you any value so far, may you kindly click like and subscribe to our channel. This will really help us a lot, and we owe it all to you. Thank you. Number 10, reacting to media influence. Relying solely on media as a source of investment analysis is a common error. The constant flow of information from 24-hour news channels may present tradable information, but successful investors seek valuable insights from multiple independent sources and conduct proprietary research. Using the news as the sole source of investment analysis is risky, as by the time the information becomes public, it has likely already been factored into market pricing. Number 11, chasing yield. The allure of high-yielding assets can be strong. However, investors should be cautious, as past returns are not indicative of future performance. High yields often come with high risks. Focusing on the entire investment picture and not getting distracted while disregarding risk management is crucial. Understanding the risks associated with chasing yield ensures a more balanced and informed investment approach. Number 12, working with the wrong advisor. Selecting an investment advisor should go beyond mere technical competence. A financial professional and service provider should share a similar philosophy about investing and life. Taking extra time to find the right advisor is crucial for a successful and enduring partnership. The benefits of aligning with an advisor who understands your goals and values far outweigh the convenience of making a quick decision. Number 13, not doing due diligence. Thorough due diligence is crucial when entrusting others to manage your money. Numerous databases allow investors to check the training, experience, and ethical standing of those managing their investments. Asking for references and verifying the work of recommended investments is a prudent practice. Taking the time to conduct due diligence can prevent falling victim to fraudulent schemes and provides peace of mind. Number 14, not reviewing investments regularly. Investing in a diversified portfolio means that some investments will perform better than others over time. Regular reviews at least once a year ensure that the portfolio remains aligned with financial goals. Diversified portfolios may require rebalancing to maintain a sensible investment strategy. A periodic check helps to ensure that the overall portfolio still makes sense in the current financial landscape. Number 15, paying too much in fees and commissions. Investing in high-cost funds or paying excessive advisory fees is a common mistake. Even a small increase in fees can have a significant effect on wealth over the long term. Before opening an account, it is crucial to be aware of the potential cost of every investment decision. Seeking funds with fees that align with their value and ensuring value for the advisory fees paid is essential for optimizing investment returns. Number 16, focusing on the wrong kind of performance. Investors should distinguish between short-term and long-term performance goals. Speculating on short-term performance, especially for long-term investors, can lead to a misguided strategy, focusing on factors that drive long-term performance rather than getting swayed by short-term market fluctuations is a worthy undertaking. Through focusing on the long-term, investors can maintain a more strategic and consistent approach to their investments. In conclusion, the journey of successful investing is paved not only with learning from one's mistakes, but also by drawing wisdom from the experiences of others. As the renowned investor Warren Buffett aptly puts it, try to learn from your mistakes. Better yet, learn from the mistakes of others. By staying focused on long-term performance factors, avoiding emotional decision-making, and making informed choices, investors can navigate the complexities of the financial markets and build a robust and resilient investment portfolio. Thank you so much for making it this far. If you have another point that we are missing, please leave it in the comment below. We would love to hear from you. Thank you, and as always, stay blessed.